Hi, I'm Dave Kang, and I started the video channel Fledgling Finance to just provide basic information to people. There's an interesting article in Kiplinger's about how the IRS taxes retirement income that I thought would be useful to go over. It covers the different types of accounts and whether or not your income is taxable and to the extent. So the first thing is Social Security benefits. They can be taxed up to 85% based on your income tax rate or your other income. Pensions are fully taxable. So it's just like being paid to work. You're paid to be retired by your former employer, and that's all taxed. Interest-bearing accounts, savings accounts, I-bonds are all taxable, but municipal bond interest is not taxable at the federal level, but it could be taxed in your state or locally. Sales of stocks, bonds, and mutual funds. It's in a taxable account. It's based on capital gains distributions, and it has different income thresholds. There is a income level where you can have your long-term gains tax-free. It may be less than what you want to live on, but it is worth exploring what the tax implications of your sales, and there can be relatively big jumps in the amount that's taxed, or you'd have to sell more to be able to have the same level of income. Dividends are taxed at the long-term capital gains rate if they're qualified dividends. That's going to be identified on your 1099 form, and it basically means that you held the security for a certain amount of time. The company made less buybacks and paid the cash back to shareholders directly versus through stock buybacks. Traditional IRA and 401ks, you defer the taxes on those, or you make pre-tax contributions. So when you take that money out, the taxes are deferred, and that is going to be taxed as ordinary income. So again, how much income you have at the different tax rates, and all these things are going to combine. And the more you take out in the different areas, the more you have pension income, the higher tax bracket you'll have, and then the taxes that you'll pay on your accounts will be higher. An exception of that is going to be Roth IRAs and 401ks. For those accounts, you pay on the taxes when you make the contributions, so you're then able to take the distributions tax-free after 5 years. There's some qualifications for that, buying a house and other things. So it's more of a longer term, but then that money will compound the longer you have it, so it's still a win-win. Life insurance proceeds are generally not taxed when received as a beneficiary. So one of your contribute ideas is, if you want to pass money to your heirs tax-free, is you can take money that you have and buy life insurance policies to pass that on to your heirs. Savings bond is again taxable at income rates. Annuities, it really kind of depends on how you pay for them. I wouldn't necessarily recommend annuities. And then home sales, real estate represents a large portion of people's net worth generally. So if you're married, you can defer $500,000 of taxes on that each time you buy and sell a house. And then that income tax is the $500,000 in gains is excluded from income tax. If you're single, it's half that. And then if you make gains over 500,000, that income is taxed. It's also worthwhile to understand the benefits of living in different states. So whether or not your state has income tax or not can have a huge impact on how much money you're able to save and retain from your retirement accounts to live on. Thanks, and hopefully this information was useful.